Welcome to another episode of China Update, where I provide you with the most up-to-date political, economic, and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in. Happy Wednesday, everybody. Today's video is very economy focused. However, as we discuss supply chains, trading blocks, and energy security, it also touches on geopolitics. Yesterday, Tuesday, China held its first China International Supply Chain Expo and the Global Supply Chain Innovation and Development Forum in Beijing. Over 500 Chinese and foreign companies are attending the 5-day expo, of which 26% are from overseas. Premier Li Qiang was the keynote speaker for the event. In his speech, he said the event is the world's first national-level supply chain expo, and that maintaining the resilience and stability of global industrial and supply chains is an important guarantee for the promotion of global economic development, adding that China stands against protectionism and various forms of decoupling and supply chain disruption. Quote, "The PRC policymakers are really starting to feel pressure on supply chain de-risking, and one objective of dual circulation is to build global supply chains more tightly to the PRC. The Biden administration appears to have hurt some feelings by announcing the day before this expo a new White House Council on Supply Chain Resilience." End quote. Indeed, on Monday, the White House did announce nearly 30 new actions, quote, to strengthen supply chains critical to America's economic and national security, end quote. And yes, this has provoked an angry response from state media. On Tuesday, in a special editorial, state-run The Global Times expressed, quote, "Washington's intentions are evident. It aims to permanently solidify its position at the high end of the global industrial and supply chains, which means keeping a large number of developing countries in a subordinate or even economically enslaved position, making it difficult for them to break free. This is a manifestation of economic imperialist thinking. The fact that some media outlets view the China International Supply Chain Expo as an attempt to form another camp of supply chains dominated by China shows their hegemonism and narrow-mindedness. In fact, China has never approached the issue from this perspective when it comes to maintaining the stability of the industrial and supply chains." End quote. Whether state media likes to admit it or not, it does appear that we're seeing a fracturing into competing trade blocks and supply chain systems. In a new report called The Shape of the Fractured World Economy in 2024, UK-based Capital Economics argues that while in the past, quote, most governments had believed that closer economic integration would promote long-term prosperity, now integration is seen as a source of risk and insecurity. End quote, adding that due to the worsening Cold War-like relations between the US and China, the global economy is being reshaped into fractured trade blocks. Capital Economics argues that countries can be divided into 5 groups: the US and its close allies, countries that lean towards the US, the unaligned, those that lean towards China, and China and its close allies. The first group consists of the US and Canada, the UK, the EU, Japan, Australia, and New Zealand. The fifth group includes China, Russia, Iran, and Pakistan. Based on this division, Capital Economics argues that the US has a large advantage over China in the coming competition between the blocs. The China bloc accounts for about half of the world's non-Antarctic land mass, compared with 35% for the US bloc. It is also home to slightly more of the world's people, 46% for the Chinese bloc versus 43% for the American bloc. But the China bloc still only generates 27% of the world's GDP, nearly all of that from China itself, compared with 67% in the US bloc. China's share of the world industrial output was 38% in 2022, against 55% for the US bloc. In agriculture, the China bloc generates 49% of output, compared with 38% for the US bloc. In 2022, 144 countries traded more goods with China than with the US. The US was the bigger trading partner for only 60 countries. However, half of global goods trade was among countries making up the US bloc. The US bloc remains dominant in financial activities and capital flows. Some 86% of global portfolio investment is within the US bloc and only 2% within the China bloc. Foreign exchange reserves also consist of assets dominated by the US currency and those of its allies. Quote, "Many countries wish to see the US and its allies, the dominant powers of the last 2 centuries, taken down a peg or two, but they are more united and economically powerful than China's group of malcontents. The event likely to change this balance quickly would be a US decision to tear its alliances to pieces. That would be one of the most dramatically self-harming acts in global history. It would take far longer for the China bloc to surpass the US bloc on all relevant aspects of economic weight. It may never do so." End quote. Next up, we look at the Russian vassalage to China as an energy producer, the Belt and Road Initiative, and we return to the theme of China's national economy. But first, I have a big favor to ask. For anyone who is watching this and enjoying the content or getting some value from it, subscribing, hitting the bell notification, and liking are all a big help. This is the main way the channel can grow. If the channel grows, it means I can allocate more time and resources into it and hopefully make this my full-time job. And for anyone who can go the extra mile, Patreon and Buy Me a Coffee links are in the description below. This channel is primarily supported by subscriber support rather than corporate support, and I want to keep it that way. Thank you so much, everybody, for the ongoing support. Next up, and while we're on the previous theme, Moscow may already be feeling the uncomfortable chafing of economic integration with a Beijing-dominated bloc. Hong Kong-based South China Morning Post, in an exclusive report published this week, citing Russian sources and Chinese analysts, writes that construction of one of Russia's key natural gas projects, the Power of Siberia 2 natural gas pipeline, to ensure a financial lifeline overseas, is likely to be slower than expected, quote, as China seeks to leverage its bargaining power, end quote. The pipeline is a deal Putin needs to offset the loss of the EU market. If completed, it would divert 50 billion cubic meters, 1.8 trillion cubic feet, of natural gas per year that previously supplied Europe to North China. The South China Morning Post cites its sources expressing, quote, Beijing understands really well their bargaining power, and the country is in a much stronger position. It's a specific presidential level of pressure. It's about cheaper payment. They can demand deep discounts, end quote. Adding, quote, Putin is under enormous pressure to build the pipeline, or otherwise a huge amount of gas will be wasted and Russia will lose a lot of money, end quote. However, even if everything goes swimmingly from now on and the Power of Siberia 2 is successfully implemented, it will not be able to compensate fully for the loss of the European market. As we just mentioned, Power of Siberia 2's potential capacity is 50 billion cubic meters. In 2019, Russia sold 165 billion cubic meters of pipeline gas to Europe and Turkey. Quote, this is a market with many suppliers, and China has plenty of alternatives, even without taking relatively expensive LNG into account. It also buys gas from Turkmenistan, and there is ample room to significantly increase those purchases. The only factor that may deter the Chinese leadership from doing so is the desire to diversify its supply chains. In any case, China can afford to simply wait until 2025-2026, when significant new volumes of LNG from the United States and Qatar are due to enter the market, as well as lowering gas prices. The other major risk is that of future instability in demand for gas. The project's biggest expense is construction costs, which will have to be recouped over 2 subsequent decades of operating at full capacity. However, the overland delivery of gas from Russia, which is increasingly dependent on Beijing, could comprise an additional element of China's energy security. It will come in useful in the event of a trade war with the West, or a situation in which shipping routes for the delivery of LNG are jeopardized for any reason, end quote. And while we're on trade blocks, one more thing. Over the weekend, the office of the leading group for promoting the Belt and Road Initiative in Beijing released its document on the vision, actions, and implementation for the Belt and Road Initiative in the next decade. An official with the National Development and Reform Commission said that the document presents the vision for measures for high-quality Belt and Road cooperation over the next decade, on the basis of summarizing BRI achievements and experience over the last 10 years. In addition to what the Belt and Road Initiative has focused on over the past decade, that is, policy coordination, infrastructure connectivity, trade, financial integration, and people-to-people ties, the document said that in the next 10 years, the focus will shift to include green development, new forms of models of digital cooperation, technology innovation, and international cooperation in health. On this theme, over the weekend, Zhou Xiaochuan, the former governor of China's central bank, the People's Bank of China, gave a long speech on the Belt and Road Initiative. For our purposes, it is worth taking note of 3 points. First, quote, the notion of the Belt and Road Initiative debt trap is greatly misleading. While mainly mentioned by international media, the discussions are often uninformed. The debt trap narrative has done significant damage to the Belt and Road Initiative and its financing." End quote. Second, quote, "Why does China have so much investment and financing in the Belt and Road Initiative? China's total investment and financing in the initiative could amount to $2 to $3 trillion US. Some in the West may wonder why China, with its moderate GDP per capita and tight fiscal conditions, is engaging in so much overseas investment and financing. Is it government-led? The reason is that China has developed economic advantages in foreign investment and financing, meaning it has a comparative advantage that can be utilized for the Belt and Road Initiative." End quote. And third, quote, "Sometimes this comparative advantage is also referred to as excess capacity. In fact, excess capacity and comparative advantage are interconnected. If a production has a comparative advantage, it can produce and export more, indicating supply exceeds domestic demand. While some Westerners clamor about decoupling from China, recently the current external conditions facing Western markets are not so favorable. Thus, even more attention should be paid to the countries along the Belt and Road Initiative. There are many opportunities in the initiative, and China should seize them and leverage its advantages in production capacity and funding capabilities." End quote. And finally for today, the new head of the People's Bank of China, Pan Gongsheng, speaking at a high-level conference co-hosted by the Hong Kong Monetary Authority and the Bank for International Settlements in Hong Kong, tried to reassure his international audience, mostly made up of global bankers, that while China is currently undergoing a painful economic structural transition, China's economy has, on the whole, continued to gain momentum in recovery and is expected to achieve the 5% growth target for the whole year, and, quote, "will enjoy healthy and sustainable growth in 2024 and beyond." End quote. He also downplayed concerns over risks related to property and local government debt issues, saying, quote, "The traditional model of relying heavily on infrastructure and real estate might generate higher growth, but it would also delay structural adjustment and undermine growth sustainability." End quote. However, it appears that China's healthy and sustainable growth in 2024 and beyond still means reliance on growth-fueled spending. State-run Securities Daily reports today that China will employ 2.28 trillion yuan, $320 billion US, of next year's special local bond quota by the end of December. This represents the early use of 60% of next year's special, that is, in addition to regular bonds, local government bond quota to the provinces. US-based outlet Bloomberg writes that this implies the overall size of next year's special local bond quota, primarily meant for infrastructure investment, could total 4 trillion yuan. China increased its headline deficit to the largest in 3 decades last month. It appears that next year's deficit could be as high or higher. Bloomberg writes today, quote, "The Chinese government's decision to release the quota early would signal President Xi Jinping's commitment to bolstering economic growth through infrastructure spending. It also suggests policymakers will not scale back on local governments' special bond issuance, even as they ramp up sovereign bonds to fund construction of infrastructure and housing." End quote. To once again quote the head of China's central bank speaking in Hong Kong this week, "The traditional model of relying heavily on infrastructure and real estate might generate higher growth, but it would also delay structural adjustment and undermine growth sustainability." End quote. Okay, that is today's episode of China Update. Thank you so much everybody for watching. Have a good Wednesday, and I will see you all tomorrow.